Welcome to this week's video. In this week's video, I want to talk about the income statement. I hear quite often that it's hard to read the income statement, or I don't know how to read the income statement. I get it from my accountant, but I don't quite know how to read it. So in this week's video, I'm going to not only show you how you can read it, but better yet, how you can use it in your business and why it is one of the most powerful things that you can use in your business on at least a monthly basis. So let's get into it. So the components of the income statement, there are four main components of the income statements that we'll go through. The first one obviously is revenues, right? Revenues are going to be cash that you may collect on sales. It's credit charges that you may have with customers, and it also could be invoices that you invoice to your customers. The next component is going to be cost of goods sold. And cost of goods sold are costs that you incur that directly relate to delivering your product or service that you do. So those are going to be such things like if you purchase materials that you utilize in what you sell. It's going to be the labor that gets involved in getting that product out the door, and it's going to be supplies. What it's not going to be is supplies like office supplies, like if I have to buy pens or paper. It's not going to be labor that relates to, G&A type wages, what I mean by that is like maybe you have a sales team that goes out or a marketing team or other office that somebody answers the phones. Those we'll get into. Those are operating costs, but they wouldn't be costs per se that are directly related, and that's the key. They're directly related to getting your product out the door. And I'll go into an example later on and kind of explain that a little bit more because it is a little bit confusing. So operating costs are going to be the costs that you incur basically to keep the lights going and to generate more revenue for your business. Operating costs are going to be like rent, right? It's going to be you might have a sales team. It's going to be professional fees. It's going to be office costs. Things like that are going to be part of your operating costs. The next section you have is what I call non-operating costs. This is going to be things that are not necessarily within your control, and they're almost kind of strange in how they impact your business, but you don't really have control over them. So we put them in an other income and expense account. So those things are going to be like interest costs on debt. You're going to have depreciation of your equipment that you have bought and is recorded. And then you're going to have things like tax expense. So they're really kind of things that you can't necessarily control, but they don't necessarily contribute to the operating of your business. And so what's left is profit. Profit would be what's left in the income statement. And again, I'll go through an example to kind of explain these buckets a little bit more and what you can kind of expect to see in them, and then what you can actually do with them as well. But first, I wanted to talk about one thing that I come across quite a bit, and that's cash basis versus accrual basis. It is a technical term, but what it really is getting at is how do you reflect and record those transactions that go into these buckets. So there are basically two ways that you can look at your financials or kind of think about how you should be recording your transactions in your financial statements. The first is the cash basis. This one is what the IRS really requires from you as far as your tax return. Now you can, in the IRS, you can actually use the accrual basis, but for the most part, you're going to use the cash basis of accounting for your tax return. And what that really means is that you record the transactions when the cash leaves the door or comes in the door. So when you make a sale, you record that transaction, and that's reflected in the period that transaction actually occurred. So you may get a car or a product that comes in, and you're working on it in the month of, let's say, March, and you get that pretty much all done in March, and you ship it April 1st. Well, you're going to recognize that if you're on the cash basis, you're going to recognize the sale on April 1, even though all your labor costs and all your costs to get that car or product completed or delivered was occurred in the previous month. And that's where the accrual basis comes in. The accrual basis is trying to match that revenue and the costs, or trying to match them on the same level versus being on a different level. So let me give you an example. Let's say you buy some materials that you utilize to produce your product, and you don't pay for that for 30 days later. So in that case, you would be recognizing that expense, if you use the cash basis, when you actually pay for that. It depends on how you pay for it. You may use a credit card. In a credit card, you would record those transactions when those transactions actually occur. So you sort of are utilizing the accrual basis in that case. But for the most part, the financials would be on a cash basis. So that's why you hear cash basis versus accrual basis. And the reason why I'm bringing that up is because you kind of need to take a look at your business when you're analyzing the numbers and think of, okay, should I be using the accrual basis or should I be using the cash basis of accounting? For the most part, you want to use the accrual basis, but it is a little more work, and you really have to look at it to see the cost versus benefit of maybe there's really not a heck of a lot of difference. And a lot of times when I see businesses that use the cash basis, I'll look at it over a period of, say, 3 months and compare those periods. And the reason why I do that is because the cash versus accrual, the difference tends to get smaller as time goes on, because it's really just all about timing difference of those transactions. So let's take an example. Let's boil this down, and let's look at an example that kind of makes sense of what these buckets are and what you can actually do with these financial statements and how you read it. Let's say you own an auto repair shop. Okay, so you have the buckets in here, right? You have your sales labor, you have your sales parts and other income. So when you look at your revenue, you can record your revenue all in one account, or you can break it out. I like to break it out into major categories because that way you can actually utilize your P&L, and it can become useful for you to make decisions and see how your business is doing. The same thing goes for cost of goods sold. Break it down into the major categories that make sense for your business in order to be able to analyze those numbers. And I'm going to show you just what I mean shortly, and how you can analyze those numbers. So you can see that I have them broken out in categories so that you as a business owner can see, well, what's going on in my various categories of revenue and cost of goods sold. Same theory for operating expenses. You got to break them down into what makes sense for you as a business owner. And remember, this income statement is for you as a business owner to be able to analyze your business. Yes, you got to do it for taxes, no doubt. You got to have something ready so you can do it. But if you're going to go through all this work, you might as well get it right, and you might as well be able to utilize it in your business in the way that you as a business owner need to be able to see it. So then you have your other income and expenses, like I mentioned earlier. That's going to be, maybe you got interest income that you earn from a savings account, depreciation, and taxes. All right, so you got all this stuff, and you look at it and you go, okay, my revenue, it's increasing from year to year. That's great. My gross profit is increasing from year to year basis. And again, my gross profit is going to be what I earned on the sales that I received, what I earned based on getting that sales or getting those products and services out the door. And then you're going to have your operating expenses. And in this case, my operating expenses are increasing, which, to be honest, is maybe not that bad. But we'll get into that in shortly. But as your business is growing, you kind of anticipate your operating expenses to sort of go up. Maybe you did some more marketing. Maybe you did some more office expenses. But again, if you don't have the data and you don't have it in front of you in the right buckets, you can't really analyze it. So let's take a look at the numbers and see how we can maybe break this down a little bit more and tell us a little bit more information. So if we look at revenue we said was going up, which is great. But it actually, when you look at the revenue percentage change, it's actually decreased slightly. Now, I have no number in 20X1 because I don't have the previous year to calculate the change, but you can see in X2 to X3, revenue actually went down. So what's going on there? You want to maybe look at what's going on. The gross profit as a percentage of revenue. Gross profit dollars was going up, but yet my margin is going down. I'm incurring more revenue, but I'm having to work harder to maintain that profit margin from what I'm selling. And my labor has gone up as well as a percentage of revenue. So maybe that's causing some issues there. My parts margin decreased slightly. That parts margin is purely your sales minus the cost of the parts, and divide that profit divided by the revenue gives you that margin. And then operating expenses. Actually, my operating expenses went down as a percentage of revenue, even though it went up as in dollars. And my operating income as a percentage of revenue actually stayed flat, even though my gross profit margin went down. So as you can see, there's a lot of things going on in here that you might want to go, all right, I need to break down further why my gross profit margin is down. Or maybe you expected that to be that way. And so my point is that you can take these numbers that you have in your income statement, you could break it down to give you some data that you as a business owner need. And in this case, you have data that you can use that doesn't take you long to get. And on a monthly basis, you get these reports and you're able to drill down and find out what really is going on in your business. Now that you have a proper income statement, you can utilize that to help drive profitability in your business. And that's really what an income statement is meant to be. It's not meant to be just for taxes. It's not meant to be something that is dreaded, like I just got to get it done because my accountant is asking me for it. It's meant to be a tool that you can utilize in your business. So, in summary, hopefully I got across the point of the income statement is powerful. It certainly is powerful if it's used in the right way. If you're tracking expenses, if you're getting data that you need in the right way, utilize it to analyze your trends. I showed you an example of how to utilize it. There are many different ways you can, but again, it makes sense to work with your accountant to make sure that they understand your business, they understand what you need to know as a business owner, and then put that together so that you get that on a monthly basis and you can analyze those numbers. Focus on the 80-20, and what I mean by that is 20% of the numbers in your business are going to drive 80% of the results. And really, if you look at your income statement, you really take a look at it, you can pretty much break it down into the buckets that I gave you, but a few expense items and revenue items that are going to drive the majority of your business. So labor costs, you're going to have occupancy costs, you're going to have supplies, things like that. There's only going to be probably a handful at most of things that you really need to focus on to get a good analysis, each month. And again, think about the cash versus accrual. You may run a hybrid system where maybe some things are recorded on the cash basis and then you fix things on an accrual basis. For example, labor is a good one. If you're paid every 2 weeks, for example, there are 2 months out of the year where they're paid 3 times in 1 month. You may want to smooth that out so that you're recording the actual labor that you incurred in the correct time period versus when that's actually paid. Okay, so if you have like the last 2 weeks of the month, you have X amount of labor that you incur, but you don't pay them till the next month. You want to make sure that you get that. You may want to make sure that you get those labor costs recorded before you actually make the payment. Okay, so if you like this video, it'd be awesome if you subscribe and hit that thumbs up button. And until next time, I thank you for watching.